Hey traders, today we're deep diving into a powerful trading indicator, the average true range, or ATR. Ever wondered what it is, how it works, and what you can use it for? Well, you're in the right place. ATR is a volatility indicator that helps us understand the market's price movement over a given period. But it's not just about directional movement, it's about the range of price swings. It looks at the differences between the high and the low point of each trading candle and gives us the average of these indicators over a set period. Let's break it down. So in the example here, you can see that there's a period at the start of this chart where there are some relatively big candles with large differences between the high and the low price. So the ATR here is relatively higher. Later, as we move across the chart, however, you can see the price start to consolidate and we have a larger number of small candles, and this is reflected by the ATR decreasing in value. So how can we use this knowledge to our advantage? We know that a falling ATR suggests a period of consolidation, usually seen when a price has been moving in one direction and comes up against a support or resistance level. A rising ATR, on the other hand, suggests that momentum is gathering and that the asset is on the verge of a breakout in one direction or another. This gives us a clearer picture of the average volatility, allowing us to gauge the potential for price movements. The most practical way that a trader can apply this is by setting a dynamic stop. By setting a stop loss or take profit at a multiple of an ATR above or below their entry price, they can take advantage of sustained momentum and ride trends that have consistent volatility levels. For example, if I bought in at 30,000 when the daily ATR was at 1,000 and I wanted to set a 2 ATR stop loss and a 3 ATR take profit, then this would mean a stop loss at 28,000 and a take profit at 33,000. The good thing about the ATR as a stop, rather than a fixed price, is that because it's a rolling average, it readjusts as the price moves. So if there's a continued momentum in one direction without a particular change in volatility, then you can ride this trend, and it means that you could be taking more profits at the end when you do exit. It can also mean that you ride the wave down, however. So remember that you need to combine it with other indicators to make sure that you're finding the right market conditions. It's also important to understand because it's used as an input to one of my favorite indicators, which I'll talk about in my next video. Hopefully that's helped, hopefully it's been interesting. Stay tuned, happy trading, and see you next time.